Welcome to the weekly update, where we'll look at the action in the market for March 7th through March 11th, and then we'll see how things look for the week of March 14th through March 18th. And a lot of things happened. A lot of that was geopolitical. We really haven't gone anywhere as far as the market is concerned. We're still in a range. And some days we have really powerful up moves, other days we have down moves. When everything is said and done, we really don't see a lot of change that's taking place right now. So let's go back and look over the week session and try to hit the high points here. It was a roller coaster week, and pretty much every week is like that. You have up times, down times, shifts, plateaus, things going up and down. But overall, we still remain range bound. We really haven't decided if the market's really going to get going to the downside, or are we going to get going to the upside? It's just kind of like a treadmill that's happening. But on our weekly charts, things are looking more negative right now. For the week, volume was above average. So we saw a lot of participation. What we're looking at right now are that the technicals are negative, and you'll see that as I go through the charts. We're getting kind of close to the end of earnings season, and then there's something that I want to go through to talk about some adjustments that are being made to earnings, especially as they apply to the S&P 500. We did have the inflation report that came out this past week, CPI, and that's where the official rate is released. Interest rates are going all over the place right now, but this coming week, we will see the Fed meet, and there's over a 95% chance that the Fed is going to raise interest rates, and it looks like 0.25% to 0.5%. And then the big thing that people are talking about includes the Ukraine-Russia situation. A lot of geopolitical things happening right now. Our trend overall is getting stronger. The ADX is going up, and it is a negative trend right now. So what are some of the notes that we can make based on what happened? And this isn't everything. This is just some high point things. Oil got up to over $130, but then by the time things were said and done on Friday, we closed at about 109, which is still very, very high, but we were a lot lower than 130 at this point. And when you see a parabolic rise like that, it's not a real surprise if you see folks coming in to take some profits, especially when they're trading futures contracts that are heavily leveraged, and you're taking a little bit of money, turning it into a lot of money, and you're seeing pretty hefty profits. You might want to go ahead and take those. Nickel was another story this week where it just went parabolic and has really spiked. Inflation, I'll go through some of the charts that were released this past week. And then the geopolitical things, Russia, Ukraine at the forefront. The Iran talks have pretty much ended, and there wasn't really any conclusions that were reached. And I don't know right now if they're going to get back together at some point, but at least nothing was really solved this past week in that situation. So looking at the intraday chart, and each one of these bars is 10 minutes. Over here on Monday, right about where my cursor is, we did go down right off the bat, and we had a pretty solid down day on Monday. Tuesday, we tried to bounce back up, but this might have been short covering that was going on, because once this spike up ended up happening, we went right back down. We tried to bounce again, and then we finished right near the lows for that session. Wednesday was more positive. We gapped up and saw sustained buying throughout the whole session. But then Thursday, we gapped lower and kind of treaded sideways. Friday, we gapped higher. It looked like things were going to go pretty good. But then we saw selling into any kind of strength. And then as the day went on, we just saw a real drifting of prices and ended up closing right about at the low for Friday's session. So overall, the Dow was down 2% for the week. The NASDAQ 3.5%. The S&P down 2.9%. And Russell, which are the small caps, they were down 1.1%. They actually outperformed. Even though they were down, they weren't down as much as some of the other indexes. And there's some things that I've been talking about in my daily videos that show that we might be seeing something positive happening. There has been other times when small caps have started to bounce a little bit before the bigger stocks, and sometimes that can lead to prices going higher. But sometimes that doesn't happen either. But it's just something to be aware of and to watch for. Looking at our different indexes, the small cap, they were down the least, where you have the S&P 400, the mid caps, and then the Dow was down almost 2%. The NYSE was down 2.33%. The S&P 500, which is what we focus on, down 2.88%. But then NASDAQ, both the NASDAQ and the NASDAQ 100, they suffered the most losses during the week. Looking at the different sectors, this is just a Friday to Friday snapshot of what happened. And since it was down overall, that's the way I sorted it, with staples performing the worst of all of the sectors. We had technology, communication, discretionary, all of these were down. The only sector that was up for the week was energy. And that's largely due to oil prices and heating oil, natural gas, and the whole sector is actually performing quite well right now. It was up 2.15% for the week. Then to see this graphically for the week, discretionary was down 2%, or excuse me, up 2%. And that's an area that has really been getting hit hard lately, where staples saw a lot of the decline overall. As far as sentiment, how are people feeling about things? On Thursday, we have the AAII report that comes out. These are individual investors, and they're showing more of an extreme negative reading right now, which could be positive for the market because we use this as a contrary indicator. Another thing that came out that we can also use as a contrary indicator is the ratio of bearish funds, down funds, to bullish funds, up funds. And we're starting to see that spike currently. Now, it's gone a lot higher than that in the past. This chart goes all the way back to 1998. But if you look at it compared to more recent history, we're showing kind of an extreme reading right now, which could be potentially positive for the market. Another thing that could be a little bit positive, but is probably more negative, is a weekly chart of the VIX. We closed down a little bit, so fear subsided, at least from the previous Friday. But if you look at the bars, we're seeing the same thing on the daily chart. We're seeing pretty much a series of higher highs and higher lows. We're not seeing any kind of a blowout fear reading right now. We're just seeing more of sustained fear as we go down to sideways throughout this whole mess that we've been having for most of 2022 so far. Another gauge that we look at for how people are feeling is called the ulcer index. When this spikes up, that means there's a lot more fear. When we're above the moving average, that also means that fear is getting greater. Well, we're starting to spike up. Ever since we set that all-time high in early January, we've been seeing fear really increasing. Now, it could go higher from here, but it just also confirms some of the other signals that we're looking at right now as we go lower overall. Another thing that came out is the University of Michigan consumer sentiment. That's how people are feeling about the economy, feeling about things. That's the blue line. When this is going higher, people are feeling better about things. When this is going lower, people are not feeling as good about things. We can also compare that to the yield on the 2-year. In a really good, healthy environment, like we saw from 2012 going into 2018 or so, even into 2019, kind of up to the COVID plunge, we saw people feeling generally better over a period of time. Well, interest rates were also rising during that time as well. What we're seeing now is the two are going in exact opposite directions. Interest rates are going up, how people are feeling or sentiment is going down. And it's starting to give us kind of an extreme reading. How is that going to play out? It's really hard to say at this point. We are in a high inflationary environment, so interest rates pretty much have to go up. People are paying more for food, gas, energy, everything. And so they're going to start feeling worse. So these might stay going in opposite directions for a while. But we just want to keep an eye on this overall. Another thing that I look at is, and I usually wouldn't even bring this up in the weekly video, I just talk about this in my daily videos, is that we're showing extreme fear right now with the CNN Money Fear and Greed Index. We're down at 14, and this gives you some historical perspective where we're down below 20. And you can see that sometimes this can mark a bottom. When people start feeling so pessimistic about things, that can again be used as a contrary indicator and might be a good time for the market to bounce. As far as inflation, the big report, CPI came out, the red or yellow, when you combine them, it's more of an orange look here. This is what the official number is right here, and it showed at 7.9%. If we go back and calculate this the way it was calculated in 1990, we would be at about 11 or 12% inflation right now. And if we went all the way back to how they calculated things in 1980, we would be at 16, 17% inflation right now. This is probably more realistic when you're out buying food, gas, paying your bills, and so forth. The red number might look a little better and it might make politicians feel a little better, but this is more real life with what's going on these days. Another thing that happened this week is nickel just went parabolic. And if you go back and look at this, the last time nickel did something like this was right before, this was late 2007. And this was right before the big financial meltdown. I'm not saying there's going to be a meltdown, but we're just seeing some of the same things that have happened previously. We also had an update of the Fed balance sheet, which this just shows the contradiction that's going on right now. The Fed is going to raise interest rates this week. That is to slow things down. Well, as the Fed balance sheet expands, that's to speed things up. So it's like they have their foot on the gas and the brake at the same time. If you hear about tapering, that's when these things start to kind of go down, and they get rid of these things that they bought to try to keep interest rates low. Well, we're still going up overall. And this chart is a little bit misleading. That 8M does not mean million. The bottom is million and this is million. So really what that means is trillions. So it just shows you how much the Federal Reserve has purchased in the way of bonds, especially since the COVID plunge, because they were tapering right before all of that happened. And this has really spiked up since then to try to stimulate the economy. Well, now we're kind of dealing with a really strange situation. Another thing that's a little more positive, it's the Chicago Fed National Financial Conditions Index. When we are below this black line, that doesn't mean that people are freaking out. That means that people are more positive about things. When we spike up, like here's the COVID spike, here's the 2008 into 2009 spike, and this goes all the way back into the 70s. So we have a pretty good look back for how things are. Well, if you look at where we're at right now, yeah, we're going up, but we're still below the black line right now. So this is showing that things just might be okay, but this could change pretty quickly. We might get some kind of a reading from this and see a real spike up. Because the last time, yeah, this was updated March 9th. So it's relatively recent, but sometimes the Fed information can really lag. Then another thing that we've heard about in the news this week is fertilizer. And I have to admit, I don't know much about this. This is as close to a good chart as I could find, where we're seeing a real spike. Well, farmers need fertilizer to grow crops. And if they're paying a lot more for fertilizer, they're going to have to raise their prices, which ultimately will come through to the consumer level. So we're seeing it really going up. When's the last time this happened? Back in 2008. So we're seeing some really scary things on the horizon. Now, it could change and some good things can happen. And we're seeing a potential base forming in the stock market because people are extremely pessimistic right now. But we're also seeing some other warning signs that economically we might be headed for some trouble. Another thing that was updated on the 11th, this is put out by FactSet, and this has to do with earnings. And these are just the main bullet points that I'm going to go over pretty quickly. There's a whole, 36, 37 page report that you can freely get. Just Google search this and you can access this report, where earnings growth for the first quarter of 2022, the growth estimate was at 4.8%. Okay, if 4.8% is the actual growth. Remember, they're looking into the future. This is what they think will happen. If that's what actually happens, this will mark the lowest earnings growth since the fourth quarter of 2020. Well, that was COVID time. It was at 3.8%. But just note that there is a potential that earnings could be slowing down a little bit. As far as earning revisions, and this is as of the end of 2021, the earnings growth rate was set for 5.8%. 7 of the sectors out of the 11 that we follow are expected to report lower earnings today, meaning right now, compared to the end of 2021, because they are providing downward revisions to their earnings per share estimates. So we're pulling back a bit on earnings right now. As far as their guidance for the first quarter, 65, remember there are 505 stocks that make up the S&P 500. 65 of those companies have issued negative earnings per share guidance. That means where are they going to go into the future? But 29 have issued positive future earnings. But 65 compared to 29, that's a lot more negative than positive. The valuation, and this is what we measure using the price to earnings ratio or PE ratio, the forward. Now, when I do my analysis, I look backwards because those are based on official numbers, but the stock market doesn't look that way. It looks forward into the future. The forward 12-month PE ratio is about 18.5. Now, if you're at 10 with the PE ratio, that's considered cheap. If you're at 15, that's considered to be fairly priced, not, the Goldilocks, not too expensive, not too cheap. If you get to 20, that's when prices are considered to be expensive. So they also take an average. The PE ratio is below the 5-year average of 18.6, okay, by a tenth of a percent right there, or a tenth of a point. Yeah. But above the 10-year average of 16.8. So this is meaning on a more relative valuation basis, even looking forward, stocks are still considered to be expensive on a historical basis. Then the scorecard at the very bottom, 3 of the companies reporting actual results. 2, they've reported a positive surprise. 3 have reported a positive revenue surprise. That's a lot less than usual. Okay, so I would challenge you, and there are charts and graphs and things, and this is freely available out there. Just look for FactSet information, and you can go through and study these things and see what you come up with. I just wanted to share the main bullet points from that report. As far as breadth, for the week, we had a down week, so we saw a decline based on price and volume. We're starting to get down to the moving average based on price, and we are below the moving average based on volume. We're seeing kind of the same thing on the daily chart as well. Price has been holding up a little better than volume right now. Our advanced decline ratio on the weekly chart is, they're both, the red line and the blue line are going down, and they are negative currently. Then looking at the new highs and new lows, which has been more positive. It was kind of the positive holdout on the daily charts. It's doing okay on the weekly charts. It's showing that the overall trend is still up. But if we don't see an awful lot of new highs coming in, this is going to roll over. So internally though, right now, things look a little more positive. Then our accumulation distribution, and this is a little hard to see, we're below the moving average. But when this line is declining, that means more people are selling. When this line is advancing, that means more people are buying. Well, it just shows that more people are selling on a weekly basis right now. As far as our trend, this is a weekly chart of the ADX where we are going up. That's the dark line right here, and it's above the moving average, so it's trending higher. The red line is on top and advancing, so this means it's a negative trend, and we're seeing a decline in buying power at the same time. So that is showing a much more negative picture right now. The other thing that we look at is the Arun. With this red line, when it's pegged near the top, kind of like it is right now, that means the sellers are in control. When the green line is pegged near the top, that means buyers are in control. Right now, the red line is not right at the top, but it's very near the top. Then when you take the difference between the two, that forms this oscillator, and it shows that overall we're declining, meaning that sellers are more in control. But even though for the week we were kind of a little bit flat, but it's still negative overall. The mass index, when we go above 27, that's signal number one. Now we're still waiting for signal number two, and that's when this comes back down and touches this dotted red line at 26.5, but we're not there yet. Some of the long-term charts, here are the daily pivots. We are below the pivot for the S&P 500, but we're still above S1. So this is just feeding more into that negative side of things. If we're above the pivot, that's considered positive. If we're below it, that's considered more negative. Then looking at the weekly chart with a 50-period moving average, this is more negative. Prices below that moving average. Now the moving average isn't rolling over yet, but the longer we stay below this, the more negative it is going to become. Here's also another view only using two moving averages, where we have a 13 and a 50-period moving average. We might be seeing, well, the shorter term moving average is rolling over. And if these cross, that's known as a death cross, and that could be quite negative on a long-term basis. And price is below both of these moving averages right now. Then looking at the BPI, the bullish percent index, we are seeing more sell signals being generated, and we're going lower overall. But we could go lower according to this chart. We really take notice of this if we drop below that green line. Then looking at the Chaikin oscillator, it is showing a decline on the weekly chart. And then I have a little longer term view to provide some historical context. We could go lower than we are right now, but sometimes where we're at has marked a bottom. The Chaikin money flow, it went a little bit negative last week. Well, it's more negative this week. Force index, kind of the same thing. It's more negative this week than it was the previous week. McClellan oscillator, below zero and declining. That is negative. Summation index, below zero based on price and declining, below zero. It looks like it's trying to turn up just a little bit right here, but it's still negative overall based on volume. That is also negative. Here's our momentum oscillators, which shows that we're really declining, but I've already stated that I don't rely on these all that much just because of the way they're calculated. They can't help but roll over as prices kept going higher, and that changes the calculation method. So I don't use these as much, but I still look at them. The PMO, kind of the same thing. You saw how we were just going up really nicely based on price, but the PMO was starting to roll over. It had to do that. So it's not necessarily showing us anything negative. It's just showing us that according to this calculation, it's starting to look a little bit weaker. Now, some people could read something into this and say that this is some kind of a leading indicator. I wouldn't go that far personally. Now, you may differ in how you use this indicator and other momentum oscillators, but that's the way that I've experienced them to work. That's why I don't use just one or two indicators in my analysis. Based on price, we continue to be negative, as well as based on volume with our PMO analysis. Another PMO study that we look at are those PMOs on a weekly basis are declining. Those that are giving us buy signals are declining, and those that are even above zero continues to decline as well. RSI, not giving us an extreme reading, but we're below 50 and declining. The special K, this is a little bit more positive territory. This doesn't change all that often. It is going down a little bit, but we're still above the longer term moving average. Then the short-term oscillator, we are negative based on price and volume. Williams percent R is starting to get into extreme negative territory. And the Stochk RSI has been pegged in extreme negative territory, and it can sit here for a long time. It's been sitting in this area pretty much since the start of 2022. The vortex with the red line on top, even though it went a little bit sideways, that means that sellers are in control. The green line would be buyers, and that declined a little bit in the past week. The ultimate oscillator, it's actually giving us a little bit of a positive signal. This is one of those indicators which sometimes it's really helpful, and sometimes it's just massively going in the opposite direction of where you think it would go. But I still look at it. We are slightly above 50, which means it's positive, and we advanced over the last week. The money flow index, another one that sometimes is very useful and sometimes very misleading. It's coming down here to this extreme negative reading, but we were flat to a little bit down on the week. Looking at our different charts, the Heiken Ashi, we're seeing a lot of black candles right now overall. So that just shows us price action is more negative than positive. The Kegi chart is red. That is also negative. The Renko chart has these two red boxes. That is also more negative. The equivolume, we're kind of getting back to the point where we're testing some previous support. Looking back 1 week, we declined with the ease of movement indicator, and we were down slightly when you calculate this going back 14 weeks. No real change as far as a signal being generated on the point and figure chart, but 3 new red circles were drawn this past week, and that means selling. The 3-line break is also looking more negative. Our different trading systems, our Elder system has a red bar, and we're dropping below this 65 period moving average. And the MACD that's calculated is also dropping below zero. So you can see how things are shifting more negative right now. The SAR, same thing. The dots are above, which shows a decline. For some other areas to look at, here's the S&P weekly chart, where we're still kind of in this range, but we could drop down out of that. Now, because people are so pessimistic right now, we could see a bounce up from that, where the mid caps have been going more sideways, and then the small caps have also been going sideways. but have lately been holding up better. This is the ETF of international stocks with some US stocks combined, where we're showing an overall decline and we're seeing a death cross. Mid caps having a death cross in a sideways pattern, very similar to what we're seeing on the daily chart, but looking pretty negative overall. Small caps holding up a little bit better. We did have a death cross, but this is a little more of a pronounced sideways action, which might give us some kind of a bounce. Then the industrials, the Dow, we're just about getting ready to see a death cross and prices below both right now. And then the NASDAQ, it's looking more weak. We've already seen the death cross and it also is trailing lower. NASDAQ 100, kind of the same thing, just about ready to give a death cross and prices below both. NYSE, not quite at a death cross yet, but getting there. And then the Wilshire, also more of a broad-based index. This is showing us a death cross right now. So we're seeing a lot of things coming together at the same time. The FANG stocks, which had been really underperforming, they are really having some trouble, and we have a recent death cross. ARK, not a good week. Not a good week for ARK. It was down almost 7.75% on the week and is really in a solid downtrend as well. This is a software index that we look at. It's also starting to show some declines and we're below the moving average. Some other areas to look at, we have the CRB index. This is a really good gauge that I've been using lately to show inflation. And as the CRB goes up, because it's based on a lot of those things that will eventually lead to inflation of prices, we saw a little bit of a decline with the CRB, but it's in a real solid uptrend overall. Gold saw a bit of a breakout earlier in the week, only to come back down and close near the lows for the week. And this is the gold ETF, which is slightly different than the continuous futures contract. Silver also might be coming up to some overhead resistance where we've been before. It was up almost 1% on the week, and it's actually looking a little bit better on a weekly basis. Here's oil. This is where it spiked up over 130, came down and closed at 109 1/3 by the time Friday got around. The dollar has really been doing well. This is what's interesting. You see gold going up and the dollar going up at the same time. Usually they go in opposite directions, but the dollar's been holding up. Not that it's some great, wonderful currency. It's just the least crappy currency out there. And because a lot of the trade that takes place and it's the world reserve currency, as we're seeing all these geopolitical problems, the dollar is holding up much better. Now that all may change in the near future, but for right now, the dollar is showing a pretty solid uptrend and the euro is coming down. I don't have a chart of that. It's going to be really interesting to see if the two meet up with each other on a price basis. Some of our relative studies. This is a monthly chart, but I like to look at it every week anyway. This is how are stocks performing in relation to bonds. If this line is going up, that means stocks are doing better than bonds. If this line is going down, bonds are doing better than stocks. Even with the weakness, we're still seeing that stocks continue to outperform bonds. Now, we are seeing some weakness here. We could drop below this moving average and things could get worse from here. But so far it's been holding up and we actually are coming out of a possible breakout. If we go back to this previous high, we might come down here, test this and maybe get a little bump out of that. Then this is intermarket analysis. I don't show this chart all that much, but this is just going back 1 week. This just shows the parabolic rise of oil, got all the way up and then bounced a little bit back. It's up over 70% going back 1 year, my goodness. Where the S&P has been having some trouble. Gold has been doing well. And then bonds based on price just have not been doing all that well, but the dollar is holding up much better. This just kind of takes all the, and I just go back a year on this. There's nothing magical about this. I just try to get some more recent history perspective on this chart. Another thing that we look at is gold versus the dollar. Well, we're seeing both of them going up. So this chart really didn't change all that much, just about 1/3%. Gold is what we're measuring here. So if gold really starts to take off, we would want to see this break through the red line first, and then eventually through the blue line. Then looking at the gold versus the S&P, we continue to see where gold lately has been really outperforming the S&P 500, and we're starting to see a golden cross here, a crossover positive. Then looking at growth versus value. When this is going down, that means that growth stocks are underperforming value stocks. Then we look at the NASDAQ 100 versus the S&P. The NASDAQ 100 is underperforming the S&P. The S&P 100 actually blipped up a little bit when you compare it to the rest of the S&P 500. So thank you very much. I hope you have a wonderful week. And please, if you're interested and if you have the time, I do put out videos every day. And I hope that you find those very useful and have a good week. And I will prepare the next video at the end of next week.